Hey everyone, McDonald's reported fiscal year 2023 first quarter earnings results, and I took a look at the earnings and I reviewed them. And as I always do, when I look at companies like McDonald's, I look at them from a dividend stock investor's perspective because many investors that invest in McDonald's stock do so for the dividend payment. And so in this video, I'm gonna go over what I found from the company's earnings results and share them with you. So if you're interested in dividends, if you're a passive income investor, you're gonna be interested in this video because McDonald's is one of the best dividend stocks in the markets today. Of course, as I'm recording this video, McDonald's offers investors a dividend yield of 2%, which is not um, a very high dividend yield, although it is a long-lasting dividend. It's a sustainable dividend, and it has the potential for growth. So let's look at that in excuse me. Let's look at this quarter's results as it relates to McDonald's potential for raising that dividend and sustainability of that dividend. So comparable store sales in the quarter increased by 12% compared to the same year the year before. Now, comparable store sales means sales at McDonald's restaurants that were open for at least 12 months. So this isn't accounting for new restaurants that were open in that time. It measures how much sales increased at existing established McDonald's restaurants. Comparable earnings per share increased by 15% to 72 cents per share. The company's done an excellent job of investing in its digital capabilities. That's helping control costs and it's raising prices. And in that way, it's been able to expand earnings per share in this inflationary environment. System-wide sales increased by 13% in constant currencies. So two things here. System-wide sales stands for or measures sales at all McDonald's restaurants. If you're not aware, McDonald's operates on mostly a franchising model. Most of McDonald's restaurants in operation today are owned by franchisees. And so system-wide sales accounts for all the sales in the McDonald's ecosystem, both corporate sales and franchisee sales. And then constant currency looks at total sales excluding the changes in currency rates, which there's always fluctuations in currency. And by stripping that out, you get to see the underlying demand for McDonald's products, and an increase in 13% is really, really good for a company like McDonald's. McDonald's is, over the long term, not known as a fast growing company. This is a company that, if you're lucky, will grow at mid single digits over the next decade, if you're lucky, if you're, a McDonald's shareholder. This is a low to mid single digit growing company. However, it's experiencing this greater rate of growth right now because of economic reopening, because the company's sales fell when they were forced to close. And so now they're comparing this year's sales with last year, which was less supported by consumers going inside to McDonald's restaurants. And it was more so the drive throughs, the digital order for home delivery. Now you've got that part of the business supplemented by people going inside of McDonald's, buying and sitting inside and eating at McDonald's restaurants. That's mainly the reason why sales are growing by double digits right now. In the US in particular, McDonald's is double dipping. It's attracting more customers and it's charging higher prices. So it's getting new customers and higher prices, getting growth from two sources in that regard. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Still, there is pressure to the business. McDonald's experienced double-digit inflation in the first quarter and is expecting high single-digit inflation for the full year. Most notably, the company experienced high single-digit inflation from wages. Now, that's an improvement from the type of experience in wages it was getting, 6 months ago, 9 months ago. The wage pressure has eased as the demand for labor has eased and the supply and demand balance is getting more in equilibrium. Overall revenue increased by 4%. So I mentioned earlier that McDonald's runs on a franchise business model and franchisees pay McDonald's a percentage of their sales, and McDonald's gets that as revenue. And then McDonald's has corporate owned stores where it generates revenue from. So altogether, McDonald's revenue increased by 4% and operating income jumped by 10% year over year. So both of these metrics are truly impressive. The operating income, especially because, as I noted earlier, the company's facing strong inflation, right? Double digit inflation in the first quarter. So, despite those inflationary pressures, to generate an increase in operating income by 10% year over year is impressive. Additionally, uh, roughly a month ago, you may have read in the news, McDonald's instituted a big restructuring where it had mass layoffs. So, those cost cutting initiatives are likely to boost McDonald's earnings per share, operating income prospects over the next several quarters. Now, initially, when there's this kind of campaign, those results don't show up right away. There is severance costs, there is restructuring costs that companies usually take when these announcements are made, and then 2 to 3 quarters after the initial announcements are made is when the benefits start to appear in the financial statements. So look forward to that as a McDonald's dividend investor. Digital system wide sales in the top six markets totaled 7.5 billion, representing 40% of their total sales. Why is this important for dividend investors? Because this saves McDonald's tremendously in wages. This reduces the amount of staff McDonald's needs to operate each location. If you've got a digital kiosk, you don't need as many cashiers. In fact, in the McDonald's near the university where I teach at, there's no cashiers. There's no cashiers. The only way you can order is on these digital kiosks in the restaurant. They don't have any cashiers. And so that shows up in lower costs, and lower costs shows up in higher profits. So the more they switch towards these initiatives, these cost saving initiatives, the better it is for investors. And this is a new thing, a new capital initiative that the company is undertaking, and it's got room to grow because if you visit a McDonald's restaurant, you've noticed that not all of them are like this. Not all of them have invested in the capability to have these kiosks because those kiosks cost thousands of dollars to invest in initially. They pay off longer term, but the initial investment could scare off some franchisees to begin with. Overall, as a result of these earnings results, I would say McDonald's dividend sustainability has increased. Its potential for raising its dividend has increased. And all in all, a good quarter for McDonald's, demonstrating that it can operate in a difficult environment, demonstrating it can raise prices and still attract new customers, demonstrating it can control costs. So, if I was a McDonald's dividend investor, I would be happy with this quarter. All right, that's all I've got for this video, but I've got several more of these kinds of videos coming out as the earnings season progresses. So if you would like to see more videos like this and other formats as well, I publish several videos every day, and I would love to have you as a subscriber. So please subscribe, and I hope I'll see you soon.